Even getting an amazing deal, a unicorn deal, you still have to let people know about it. Because if you don't let people know about it, how would they fund it?
Meet Natu Myers, a capital raising expert and founder of Raisers.com, where he has raised over $260 million for his clients using his proven system that builds investor relationships months before they are needed. And in this episode, he's going to share his exact capital raising playbook, including his exact outreach strategy that books minimum of 5 investor calls a week.
I would focus on investors that are local to me and local to the types of deals I want to acquire.
Nurturing a network of investors that trust you.
I will send case studies, a piece of information in the industry that's very timely, offer a free lead magnet in terms of like either a webinar, and that's how you build relationships with people.
Handling objections and securing the investment.
The idea is to turn the no's to maybes, maybes to yeses, yeses to signature signed.
Like I have heard people say that, hey, if you have a good deal, the money will come. So like you have so much experience raising capital. So do you think it's all about like consistency and long-term, like the game plan? Or is it more of like, hey, just find a good deal and money will come?
Well, I definitely think it's all about the consistency and making sure that you have a game plan in getting the capital in place first. Experience tells us that getting the best deal and even getting an amazing deal, a unicorn deal, you still have to let people know about it. Because if you don't let people know about it, how would they fund it? So definitely it's really important to get the capital and get the relationships to the investors in place first.
So let's say I've got a deal under LOI and we want to raise capital now. Like typically how long does it take, to raise capital? Like assuming I have like no connections or whatever.
We like to toss out the expectation of 6 months in general, but I mean, it really depends. Like it depends on if it's all debt. It depends on if they were approved to get a loan from in the US, the SBA, the Small Business Association. It depends on so many things. But I mean, a good benchmark would be less than 6 months, or 6 months would be a good expectation. Some people do it in days. Most people do it in many months. So it really is all over the place. So, and I don't know everyone's situation, right?
When is the best time, to start building this investors list?
The best time is yesterday, and then the second best time is today. So like as soon as possible, it's so important to make sure that you you start getting the contacts in place. I'd say like literally today, if you're listening to these words coming out of my mouth and you don't have a relationship with investors, you literally should probably start today. Drop everything you're doing and like actually pause this podcast and actually like go out to all of the investors and funders, and send them an email and give them a call, give them a text. Like there's nothing wrong with getting money in place that you're not sure where it's going to be used for until, because what's the bigger problem? Having too much money or not having enough money? I'm going to go with not having enough money. So I would never go out here and I'd recommend anybody to, expect that the money is going to come last minute. It never does. It's usually to be proactive before you embarrass you and destroy your reputation by telling a seller, hey, I'm going to acquire this type of business, and you're not able to fulfill on it. You disappoint people, and then your reputation is built as somebody who doesn't fulfill on their promises in that specific niche of types of businesses you want to acquire. So it's really dangerous to play with your reputation. So I just rather get the capital in place first, and if the deal doesn't close, let it be for a reason that's not of your own, just so that you protect your reputation. That's what I really recommend.
There's a lot of horror stories there, where they got it under LOI and stuff and they couldn't fund it. Most of the investors I dealt with, I always prefer, they have the cash to buy the businesses because it's easy for me to, close the deals quicker and make my commission quicker. So I have a basic idea of raising capital, but there is a lot of, the financial terms and like a lot of legal aspects to it. And I'm pretty sure most of the audience also have the same, thing that they know that, okay, so raising capital is basically you're giving up equity for some, the money you're getting from investors for down payment or whatever. So can you give us a quick overview of like what is the process looks like of, raising capital from, from the beginning until, like money hits your bank account? Just like a quick the process overview.
So let's say that somebody wants to raise money to buy a laundromat. Okay. So somebody wants to raise $10 million, or let's just say $1 million to buy a laundromat in the middle of Ohio. So to raise the money for that, usually you look at usually I just find that the capital is just split into two parts. There's always debts and then there's equity, you know. So there's like a loan and then there's how much you own. So usually if you want to raise money to buy it and you don't have any money yourself to buy it, you have $0 in your bank account to buy it, the first thing is you usually would, try to go to somebody. So you try to go to a lender that will lend you a percentage of the value of that laundromat. Most people, if there's real estate attached, will lend you 75%, of the value of that laundromat to acquire it, right? So you get $750,000, assuming that you have good credit, you have good, you pay your bills on time, you're not a criminal, and haven't been bankrupt, then you can probably get a loan from some bank to buy a laundromat. That's probably the quickest way to get a loan, the simplest way. And then you have $250,000 left that you have to put together to acquire the rest of it, because nobody is going to lend you 100% of the value of an asset except in extremely rare circumstances. So what you do is you go to, you partner with an investor that will give you the $250,000 to buy the laundromat. So this is what we call equity. And so, we go out, we find an investor. There are different ways of doing it, but what is the safest way is finding an accredited investor to give you the money to buy the laundromat in exchange for some of the profits that the laundromat will make. All right. So that's pretty much it. So, I mean, you can go, it doesn't really matter how it's done, and we can go into that as we go along, but even if it's done by a carrier pigeon, if it's done by running Facebook ads, as long as it's within the rules, then you can use whatever method that you like to find those investors to partner with to give you that $250,000 to buy the laundromat. So that's it in a high level. Get the debt, get the equity, and then that's pretty much it. Then use the money to send to the seller and then get the laundromat. There are many other ways of doing it. Some people do it with no money down even, but that's pretty much the basic answer to the question. And I'm happy to expound.
Most of the structures I've seen is like, hey, you raise capital for down payment, and the rest, it's like you take a loan or something like that. So if we have to raise 100% of the capital, is it going to be more of like a fund structure and take a fees out of it?
Sometimes. So sometimes what people do is that they do a real estate syndication, where what they're doing, they create a structure that is really special. So in a nutshell, what they do is they form a company called a type of partnership called a limited partnership. And a limited partnership limits the liability. So in other words, I buy the laundromat or buy a piece of real estate as an equity partner, right? So I find an investor that wants to give me the $250,000 to get the laundromat. But somebody goes to the laundromat and let's say some rock hits their head and then they fall down and then they want to sue. Okay. The investor is on the hook because if they have ownership over that laundromat with me, then both of us are on the hook for that legal disputes. But if you want the partners that you find to have limited liability, what I'll do instead is I'll have a limited partnership which prevents them from being liable to the day-to-day operations of the laundromat. So that's why the limited partnership structure is used so often. And then that's quote unquote one type of thing that people will call a fund. Okay. So, that's one aspect. And then there are different aspects. Another aspect is, okay, after 5 years, I don't want them having control over the day-to-day and over the voting rights of what I do as my business. If I want to run my laundromat, I want to be able to run it how I want. I don't want to have my investors control me and tell me what to do all the time. So the limited partnership is valuable in that it prevents people from having too many voting rights, and it just focuses on giving them for lack of better words, dividend, some cash flow, percentage of the money that comes through, as opposed to them having ownership of the actual laundromat itself. So basically, I'm getting money. It's kind of like a loan in a way that's more high risk. Basically, I'm getting money and giving back money, and they have no ownership. So then that's why funds are really. So that's more of like a syndication. A fund is where you're doing something more complex and free. Where let's say I want to buy 5 laundromats, or I want to buy 5 laundromats, 2 zoos, one shopping mall. I just take the money and then I spend it however I want, and then I give it back to the investor in the way that I promised, using through the use of funds that I promised. It's really hard to raise a fund compared to a one-off deal because people have to trust your decision-making ability in allocating and managing capital for investors.
So there is a lot of financial terms and like different like legal stuff involved in raising capital. So before we dive into how to build this investors list to raise capital, can you give us like handful of maybe 3 or 4 like key terms or key things they gotta keep in mind? Let's say like mandate, securities, and stuff, just to setting the base here.
No, absolutely. So I like to divide it into, let's say, divide it into 3 pieces. So the first thing that you have to keep in mind, regulation. So this is the legal side. So it's really important to understand, I'll say one term, the regulation, the 506C. That's the most important legal term in this entire podcast, in my opinion. That tells you everything about that. I guess on the marketing side, you just have like marketing words like pitch deck, executive summary. These are more marketing words. And then the third thing is that you have the financial information. So you have like the waterfall, cash flow statements, pro forma. So those are the financial terms. Underwriting, people's we call them mandates, criteria, what they like to invest in. So some people are like, hey, I want to invest in senior home care living facilities. Some people will be like, hey, I want to invest in multifamily. So I think as long as you know how to categorize those 3 things, then you'll be in a really good position to know what you're talking about, to know how to navigate this whole thing.
So one of the challenging part when it comes to raising capital is finding legit investors. Right now, with all the people talking about no money down deals, everyone is an investor right now. Everyone, under their LinkedIn bio, it says like investors or acquisition pioneer and stuff like that. So how do you go about finding how do you build a qualified leads, like, the investors list, so you could like reach out to them to raise capital?
Sure. So the cleanest way I would know how to do it is to, simply put, go on LinkedIn. This is the most specific way. Go on LinkedIn right now. Look at all your LinkedIn connection and like literally just go to LinkedIn and then type in investor. And then on the search bar, choose first degree connection. And then see everybody on your LinkedIn that calls himself an investor. And then just have a conversation with them.
Is there any specific filters you look for, to filtering out these investors, like while you're building the list, other than the investor key term?
So when it comes to filters, well, I mean, local is a good start. So first I'll look at local to me and local to the types of deals I want to acquire. So let's say I'm in Akron, Ohio. The business I want to buy is in Akron, Ohio. Then I'll just find investors in Akron, Ohio. One of the clients we had, he found investors that were in Vancouver, and he was in Vancouver, and the business he wanted to buy was in Edmonton. So in that case, he just spoke to the investors that were in Vancouver because he could meet them. And then eventually they went over to Edmonton to look at the deal. So based on that success story, I would focus on investors that are close to where I am at, so I'm able to have more in common with them. And then, as a bonus, if the investor is also at the place where the deals are at, that could also help. Because I had a talk of somebody who had a platform for, listing deals. And he said that most of the deals close that are close to them. So the closer everything is, the better. So you don't want to be doing business with somebody like in the middle of, like 60,000 miles away who you don't know, like right away on day one. You focus on people that are close to you and then start building from there, I think.
So the first one is like investors. Second one is make sure they are local. And like, what else?
So investors, they're local, and then, they're relevant. So relevance is the next one, because an angel investor is completely different than a real estate investor in general. So make sure that it's relevant to the types of business that you want to do and business you want to acquire. Or let's say you're a multifamily investor. I won't really be talking to too many like seed AI investors in general. Like you could, but I just don't think it's as relevant. So make sure that they're relevant.
Got it. So would you do you go after, let's say, like a specific industry? What do I mean by that is, let's say I'm buying an e-commerce business. So would you target people, who has maybe the tagline investor, and then, they should be in e-commerce, or like, how does that look like? Or you're open, like if they're investor and investing in private equity, like, is it that doesn't matter? Or how do you go about that?
Things are never as they seem at first all the time. So you can find an angel investor that invests in AI who would one day invest in a real estate deal. You can find somebody who's a private equity investor they invest in a public markets deal. So I'm not saying that it's always going to be this way, but in general, if you want a quick response and if you want something that will quickly get you something predictable in a short term, then I'll just find people that have specific relevant keywords and taglines in their profile or in their title to the type of business that you want to acquire. So that's the cleanest way, I think, to actually get something done here.
Can you give us an example, like in terms of the tagline you mentioned?
Sure. So let's say you want to find somebody that invests in e-commerce businesses, as you say, or somebody who wants to, let's say you want to buy an e-commerce business. I mean, it's pretty self-explanatory. I'll just say investor and e-commerce, or investor and Shopify, or investor and what else? Like drop shipping. And then it's more likely I'll find somebody that's relevant to that specific niche.
Makes sense. So is it like the investor key term, is it like mandatory, or you're open to maybe, let's say, target CEOs, maybe like, like the employee count and stuff. Maybe they are looking to, they have extra cash sitting around, they want to invest in it. So would you go with that, or is it like, it's better to just target people who have the investor keyword in the tagline or bio?
I'll target investor keyword. The only time I would deviate from this are some of the, here's where I'll deviate from this. I'll deviate from the investor keyword if I'm also looking at managing partner at a company that is in the business of investing. So if there's a private equity firm out there that invests, like let's say, like my role is a managing director, or my role is an analyst, and I'm underwriting deals, then yes, I will say managing director, I'll say analyst, if the business that I'm part of is a fund, or if it's a private equity company that invests, or if it's an investor, they're investor companies, or if it's, I could also say, limited partner. I could also say general partner. I could also just say partner. I could add keywords, or a CEO. Sure, I could even add CEO, but it has to be a company that is in the business of investing. If they own a bunch of, cars or something, and then I want to find an investor for a real estate deal, like it doesn't make any sense. But I mean, mostly I'll focus on the businesses that are in the business of investing.
So, I mean, you have given us a pretty good criteria. One thing when it comes to like reaching out, like cold reach outs and stuff, is like having like pretty good, what do you call, intents early on to know that, hey, he might be interested in investing or things like that. So is there any specific intents you look for, to like, to filter out, a lot of like unqualified leads, or people who you think might be like interested in investing right now? So for example, could be if we are looking for an intent when it comes to, let's say, we are finding sellers, is that one of the intent is like, hey, how long they have been in the business. So if they have been in the same business for, let's say, 10 plus years, they would be more motivated to like sell their business. So is there anything specific to that? You might think, okay, I think we use this intent to find someone who would be more interested in investing?
Yeah, there's so many ways. So one way is there's signals of intent, and there's also direct intent. One signal of intent is if there's like a new company, if some of the clients that we help at Raise.com, like sometimes they formed a new company or a new fund or a new business that wanted to do more real estate deals. So there was a real estate syndicator in North Carolina, for example. They formed this new company on LinkedIn, and then that was like a signal that they wanted to start raising money for real estate. Another signal could be somebody that is really like, this is not really a signal, but somebody who's really active on LinkedIn, because when you do LinkedIn searches, you can see if somebody's active. There's a filter on Search Navigator to see if somebody's more active. And then if somebody's more active, it's more likely that they'll, number one, respond, and number two, they're actually on the platform for a reason. Another signal could be looking at different channels. When I say channels, I mean different social media platforms, different ways of reaching out to investors. For example, if people do, like, for example, search-based ads on Google, it's more likely you find people with ultra high intent, because people are actively searching the thing on Google. You're like, how do I do this? How do I do that? That's ultra high intent. If somebody searches something like, if somebody gets like an interruption-based ad on Facebook, like it's a bit less intense. You're more interrupting their day rather than them coming to you. So, ultimately, the way that we combat that throughout all the LinkedIn messaging and throughout interruption-based ads as well is to make sure when things are qualified, when we're qualifying people to see if they're investing, is to ask them either on a Calendly booking page, when we book the appointment, you can use tools to book the appointment, or by asking them, just say, hey, when are you looking to invest? And this is what we do with our clients. It's like, okay, are they looking to do it within like as soon as possible, a couple of days, a couple of weeks, a couple of months? And then that's how you find out the urgency. To find out the intent, you can also pair that with a question like, are you looking, like, how aware are they of investing? Like, are they just like thinking about it, or is it something that they're actively looking to send money to? Because there are some people that we're working with in Boca Raton that are actively looking to send money to different companies, even without like a term sheet, just willing to send money, because they have a lot of dry powder. So hopefully there are different ways and it can go on, but does that answer the question?
Yeah, of course. The last part you mentioned was like, I think it happens like once, you ran ads and once you booked a call and you just ask them. So similar to the examples you gave in the beginning. So is there any other intents where, you could filter out even before you have a conversation with them?
Potentially, yeah. I know that there are a lot of press releases as well. When people do press releases saying that, okay, we're now raising capital for this. And there are some people that, all they do is really just scrape and go through press releases to see all the press releases that somebody has made, to see if they're actually investing and, if they're ready to, start doing that type of business. So looking at press releases, and that's how the biggest databases do it. That's how PitchBook, Preqin, all those guys do it, is that they look at press releases as well.
Is there any other data platforms like you use for this specific process, or is it like PitchBook and Preqin does most of the job?
I mean, they do most of it. Like there's PitchBook, there's Preqin, there's Axial, there's Crunchbase, Crunchbase is actually really underrated. It's pretty cheap and it's really underrated. I mean, those are all the ones that I know. And but the thing is that they're just databases, and a database isn't a relationship, but it's a good way of people finding sense. And what I know a lot of them do is they just scrape. A lot of them scrape Google search engine results page. They find all information of the new news that comes out on them. And then based on the public information, they say, okay, this company raised this much money, or this company has this much dry powder, and then based on the dry powder, they're like, okay, go talk to this person because they say that they raised a fund and they're willing to invest. So that's how some of them they do it. One way that we tried is so this is a bit nerdy, but it's to use a tool that's typed in. So what you'll do, you'll just say, sites : LinkedIn /in/user. And then, you say and quotation investor and niche. So basically what I'm doing is like, you just do a search criteria. You just do a search query on Google for like LinkedIn pages that have a certain type of user, and the way you can do, you can use something called a search engine results page API that goes through all the different results on Google or Bing. Bing is better because Bing is owned by Microsoft. LinkedIn is owned by Microsoft. So it's the indexing is a bit better. And then you can just like search whatever you want, and then you can get all the LinkedIns. And then from there, when you get all the LinkedIns, you can use third-party tools. Like there's one called Snav.io. You can get the name, email, phone number of everybody that put their information on LinkedIn that way. All right. And then that's pretty cool. You could build your own database that way.
I think like when I was doing some research, some of the podcasts you went on, I think one of the things you specifically mentioned was, hey, when it comes to raising capital, it has to be an accredited investor. You have to make sure, they are fit the criteria. So can you give us a quick overview of like what is an accredited investor and like why you should only go for them, like when you're building this list?
Oh, sure. So an accredited investor is an investor. Well, I guess let me say the background. So the SEC is a government agency that was created after the Great Depression to prevent people from getting scammed by investments. So if somebody invests and they lose all their money, it's usually really bad for for like the whole business, because people don't want to do business. So what the SEC did is they defined something called an accredited investor, and that is an individual. It could be a company, it could be so many things, but in many cases, it's an individual that has a certain amount of money or makes a certain amount of income. From memory, around $200,000, annual recurring income, or with their spouse, they're around $300,000, or they have $1 million in net worth, excluding their personal residence, or around $5 million in net worth, excluding their primary residence with a spouse, I believe. Feel free to fact check it because I'm not a lawyer. But if they have that much, roughly around that much, then they could be something called an accredited investor, which means that they're allowed to invest into certain types of deals and certain types of legal offerings, such as what I said earlier, the Regulation D 506C, which is only meant for accredited investors. So in a nutshell, and basically what I'm saying is, if you have enough money to lose, then it's safe to invest in certain types of investments. So that's pretty much what the SEC, the Securities and Exchange Commission, said. So that's what an accredited investor is. And so it's really important that you make sure that they're accredited investors if you're using the Regulation D 506C exemption or other rules that talk about the accredited investors.
So there are other ways to go about it as well, but this is like probably the safest way to go about it, like raising capital and stuff, if I'm not wrong.
Yeah, and I'll tell you this, like there are a lot of, it's probably the most reliable, it's the cheapest way, it's the most popular way. I spoke to Devin Thorpe, who founded a bunch of companies. I believe about $1 trillion like goes through that regulation on a yearly basis. So it's the most popularly used regulation for raising money in the entire world by far. So it's really well used, and it's really cheap and really affordable and really popular.
Like, do you have any filter or like any data, databases you use to know if they're an accredited investor or not? Or you do it like once they've probably booked a call in your qualification process?
Usually in the qualification, because here's the issue, right? Like the thing is, like, even if you look at the databases that say that they're an accredited investor, the status can change because people can lose money, or companies can lose status. So what we do is just qualify. We just ask them and say, hey, listen, are you an accredited investor? And then we just have the link to the description of the accredited investor. They say yes. And then even on the subscription agreements, the legal agreements that they sign, it has all that material already built in to ask them if they're an accredited investor, which is very important. So we already asked them, and then based on what they tell us, then it gives us sort of the armor to know that, hey, they're the ones who are telling us they're accredited. If you want to take a step even further, there are some services that literally go into the person's bank accounts and check to see how much money they have to prove that they're accredited. Some people even go to those distances. It's kind of extreme. Most people really don't, but depending on somebody's risk appetite and fear, they can even go that far to check if they're accredited.
Like, do you guys do it or no? Like, hiring someone to go into the bank account and like
sometimes, mostly no.
Okay.
Because like most of the people we approach are usually not really the tiny mom and pop type of investors. They're more like institutions or larger firms. So they're the ones saying they're accredited, and then usually it's all good from there.
Do you suggest going for like a one big institutional investor to fund all your acquisition, or just go for a smaller ones and just find a bunch of them and have them fund it?
It depends. So I would do this small check in accredited investors. It's so dependent on so many things. So if I'm doing a one-off deal that's not a fund, then in general it seems to be easier to find multiple investors. Because multiple investors usually would trust the track record of somebody that has more experience than them or a lot of experience. Whereas the institutional fund, they wouldn't trust the track record as much because they already have all the money, all the skills and everything. So why are they invested in my fund? So it takes a lot of efforts to build the reputation that would allow a big institutional investor to invest in somebody with a fund. Whereas if it's a one-off deal or a one-off syndication, it's more likely to get those institutional investors. Like we had a guy in Vancouver, so my Vancouver contact, who was our client. The thing with him is that that's exactly what he faced. He went and tried to find somebody to invest in his fund as an institution. They said, no, we want to do one deal at a time. So he did one deal at a time. And then that's when the institutions were more interested. So the quick answer is, if you're doing one deal at a time, it seems to be easier to get institutions and individuals. Whereas if you're doing a fund, it seems to be easier just to get individuals. So that's what we found.
So when you're building this leads list, you're looking at if they have investor profile or investor keyword in the tagline, things like that. Is there any specific things you look for or a specific filters where you say that, hey, even though they might have the investor tagline, I don't think they're a good fit, and you just remove them from the list like even before you reaching out? Is there any specific filters like that?
You have like objective ones and subjective ones. Like, I mean, there's some people that, for example, maybe they expect a return that you can't give them. Like if somebody expects like a 30% like IRR and you can only do a 20% IRR, or like somebody wants to get 2 times the return on equity in 1 year, but you can only do 2 times return on equity in 5 years. Like, you probably don't take on people that you can't fulfill for, because then there could be trouble. Because then it can sue you and there could be a lot of issues to deal with. So, I mean, there's a subjective aspect of like, okay, can I actually do what I promise I can do for this person? And if no, then probably don't take them, because the downside is, don't be desperate, and this downside is really bad. Um, Other things could be red flags. There are a lot of red flags. Like, for example, if somebody was in a lot of lawsuits, if somebody only wants to invest in crypto and then they don't want to invest in anything else, and it's like, are they avoiding something? Like, why are they hiding? If somebody, you do something called KYC, know your clients, and you do all the things that are needed to make sure that the investor is a legitimate human being, because they have to go through something called KYC, because they want to make sure that the government doesn't think that you're funding a terrorist. Like, it's literally anti-money laundering provisions that have to be followed. And they call that for a reason, because there are some people that invest in like things that are for terrorism. So if any of those red flags don't show up, then sure, go conduct business. But if you see a red flag, like, okay, I don't want to tell you where I'm born, or I don't want to tell you where I am, or I don't want, or I want to, or another one, here's a popular one. Some of my buddies, like down in Boca, they got scammed by investors that wanted them to fly to them, and then they'll say, okay, if you come to me, then I'll wire the money, da da da. And sometimes they're all just scams. So you just have to be really careful to make sure that you're not giving, even if somebody says that they're going to invest like 40 million and all this, and then you fly to them and you do all these things and you put money in an escrow by their terms and all this, and then the money disappears. Like, I've heard horror stories. So just be basic, keep it simple. You just say, hey, listen, I make you this much money and here's a form. What are your questions? And then we'll go from there. So just keep it simple, and then go from there.
So another thing, another challenge, most of the searchers or people looking to buy businesses or raise capital face is dealing with scammers, fraudsters, who are portraying themselves as investors. So are they like, do you do background checks on these investors you're talking to, or like what does it look like?
Yeah, one thing I recommend, because as we were saying before, is there's a lot of anti-money laundering provisions that they have to sign with those documents. Because the thing is that when they're signing those subscription agreements, you have to comply to the anti-money laundering laws. You have to comply with the KYC rules. There are times where you may even have to take in some information. In Canada, there's this thing with, you getting driver's licenses, you getting, even social security numbers. It's very serious. So you have to make sure that those documents are properly filed and signed when the investor invests, and then you also have to, for your own sanity, what I recommend is checking with a company called Unicourt or Pacer. So Unicourt, you can do court case lookup in the United States to see everybody who you're doing business with, to see if they're involved in any lawsuits, more for a risk protection measure. Because if somebody doesn't pay their bills, they get sued by people, they get into a bunch of DUIs. Do you really want them investing like $1 billion into your deal, and then they complain that you're the bad guy, and then they go into all kinds of issues with you? If they're like a controlling investor, you probably don't. So, you have to do your own like due diligence. I recommend Pacer. It's really cheap, or Unicorns in the US. In Canada, I recommend Calendly. That's a good one. And obviously, for goodness sakes, like, you can just Google people. There's one tool called close.com, which allows you to make outbound calls to software. And then they have like an integration where you can just see the Google results like in one click, or you can hire a coder to do an automatic legal search. Because Pacer, they have their own API. Unicord has their own API. So you just do a like automatic legal search to everybody that comes through your CRM. CRM just means customer relationship management software. So you can do that all automatically if you want to. But yeah, long story short, court case lookup, Google, and then you should be good to go.
So just to clarify, with the close.com, I think what you're saying is, like, if we do it manually, we could just go to these websites and do it manually. But with Close, you could actually integrate these API so that every lead you're feeding into this CRM, it will automatically, do these searches for you, and you'll have the results ready to go, like in the CRM. That's gonna save a lot of time for sure. So for the data you get, Do you only use LinkedIn to reach out, or do you do cold emails as well?
Yeah, well, we use like LinkedIn mainly, but then the cold emails and cold calls as a supplement. So what we'll do is like your LinkedIn connection, and then backup way will be email, SMS, call. Because we want to have an excuse for reaching out. So like we'll say, oh hey, we reached out on LinkedIn. I connected my colleague and I. We connected with you on LinkedIn. So it gives us an in and a reason to start a conversation. Is not completely cold. Whereas if it says email, we have to find another thing to, like some people do it through email really successfully. We just choose to use LinkedIn, and then we just use LinkedIn as a main way, and then we use the other channels to justify why we're reaching out. Say, oh yeah, and then by the way, you put this information on LinkedIn. That's why we're reaching out. So instead of it being some data issue, it's like, hey, you gave us this information on LinkedIn, and this is publicly available information. So we're not getting some shady database somewhere. This is the stuff that you showed us. So that's a good way to go around all the, canned spam acts, and all this stuff. It's like, oh, we're just reaching out to you based on what you put on your LinkedIn.
So let's say someone wants to raise $500,000. On an average, how many potential leads someone has to like reach out to get a check for $500,000?
So assuming that you don't have anybody warm, and I always recommend getting people warm, but assuming you have nobody warm, I'd say like it could be hundreds. So I'd say there's like a 6%, so like 3 to 6% of everybody you connect to would connect. All right, and of that, 1 in 10 of people would want to have an initial call with you. And of that, 1 in 10 of people will want to actually see the information of the deal and look at the deal. And of that, 1 in 10 of people would actually want to invest. So, I mean, we're talking about like, what is that? I said 1 in 10 3 times. So then that's probably, let's just say like that's a few thousand people, could potentially get worse. A few hundred people at best.
Got it. So like how many requests do you have to send to get that number?
Yeah, if you use some of the best tools on the market, there's a way to send 500 per week. If you use some of the average tools, you can send only 200 per week. So you need to send at least, I really think you need to find a way to send at least 500 per week, to qualified people with personalized messages to get the minimums that you're looking for. And, if you just rely on doing it manually or you don't use the right tools, then you can just be stuck at like around 200 per week.
So is it possible to share the names of the tools?
Yeah, well, there's one tool. Well, I won't go through the popular tools because the issue is that this tool, they don't want to get shut down by LinkedIn because they literally told me that, hey, I can't share it. But, for now, some popular ones that everybody knows, WeConnect is really popular. They may even be able to do that. There's also Sales Robot. I really didn't like Sales Robot because of the UI UX. WeConnect seems a bit better.
So do you think this percentage might increase if you're getting those cold people and then like warming up rather than just go straight with the pitch? Just warming up, maybe you're looking to buy a business, let's say 6 months from now, just warming them up and then, pitch them like 6 months down the road. Do you think that would increase the percentage rather than, reaching out to a lot of people?
Oh, 1,000%. That's why at the beginning, when you're asking, it was really just about getting the money in place first. So it's like a lifestyle. Raising money is a lifestyle. It's not just something that you do because you need to do it. It's actually part of who you should be as a founder of anything. It's a lifestyle. So I definitely think like you should be getting people warmed up like literally yesterday. So by the time you need the money, it's, oh, hey, guys, by the way, we have this round, invest. And then you just have money flooding in because you've warmed people up. That's why all those stories that you see of people that raise like 1 million in one day, it's really just, it took years of nurturing, years. Okay. And then that's why sometimes, when people are working on buying businesses, it takes a while to underwrite and find a good business. But by the time they find it, they don't have initial finding the money because they started raising money before they found the business. So I totally think the warmer it is, the better. And that applies for everything, for sales, like people that sell products online, people that do all this. If you warm people up, they'll buy quicker because they trust you and they build a relationship with you before you needed anything from them. So totally.
I mean, one of the reasons why I built the podcast was like, there are a lot of investors, who don't lie about, something they did, but they don't show you the entire truth. They say, hey, we raised like $10 million in like 1 week, but in reality, they might have spent like 2-3 years, building relationship and stuff. So yeah, I just let you know. So crazy thing. So anyway, so in your raises.com guide, I went through it. It was awesome. I would like highly recommend everyone to go through it. You have said that raising capital is not about finding a magic formula. It's about communicating clearly and persuasively and having a like a vision that inspires people to kind of help you turn it into a reality, right? So keeping that in mind, before we send like reaching out to people and stuff like that, how can we position ourselves to be more attractive and persuasive before we kind of like reach out to them?
I mean, I can go really granular. So let's just talk about the social world, right? So LinkedIn is pretty key. I can go through everything, but LinkedIn. Let's just start with LinkedIn. It's really important that let's get a suit on. Let's look professional for one, right? Like get a suit on, get a nice shirt on. Look like you're here to do business. Don't get a blurry profile picture. Just hire somebody, pay somebody like $100 to take you a nice picture at a minimum, like with a professional photo. Because if somebody trusts you with millions of dollars, you have to look like you spent at least $1 on yourself. So let this just look really serious, really professional, smile, frown, whatever the photographer tells you to do. And then have a specific call to action to one thing on your LinkedIn profile. Ideally, getting them to opt in to learn about your investment opportunities. You can do it by having a LinkedIn banner that has your brand on it that directs them to one call to action. And ideally, you form the company on LinkedIn that you're raising money for, and you have it well branded. You say your title, you have the call to action so that all the investors that see your LinkedIn profile can opt into that one thing. I mean, that's key. Get a graphic designer. Don't try to, if you've never designed something that people like, don't try to act as if you can. Just get a graphic designer on Fiverr for like $5 to like design something that looks decent. So as long as people are very serious about that, and then they make a clear call to action in all their pages in a professional way, then they shouldn't really have a big problem. I could go further and say that it's not only about the call to action. You should also address the specific avatar that you're targeting, because there are some people that say, "Hey, listen, we're going to raise money for a real estate syndication, a real estate deal. I help busy doctors make the money work for them." So for example, that's an example that's really worked well. So I would address a specific avatar to a type of person that you help. So if it's an investor that you're looking for, you can go further and describe the specific investor that you help and the problem that you solve for that specific investor, so that you have people that are very specific in your target personal people, like I guess your personal investor list. Make sure that when you do a Google search of yourself, nothing that you don't watch shows up. Like if somebody searches you and then they see like, some lawsuits, or they see somebody complaining about you, then you'll be really hard. Make sure that your Facebook profiles, your Instagram profiles, like if you don't want them to be public, make them private. But ideally you make them all just like focus on that one call to action to get an investor to opt in to what you're doing. That's why I recommend it in a nutshell. And, it's so important, like anybody that you do business with, like the business partners that you have, when they Google their names too, they don't see anything related to anything controversial at all. So pretty much the key is stay away from things that are like super, not controversial, but things that are like, okay, this person got a DUI, this person got sued. Because people can literally go to Pacer or go to Unicourt, or they can look up every single legal issue that you had, and it can ruin you in the sense of raising money.
Got it. So like what about let's say track record website or get a board or things like that, to make sure to make the like basically we want the investor to take us seriously, right, when we're reaching out to them. So what are the key things we gotta have so that when they look at it, they're like, oh, I think like he's serious, or he's like a legit.
Okay, so I'll put it this way. One of the people that I was working with a while ago, in down in Toronto, he had somebody wire him, like it was a stock investment actually. I'm not sure if it was a wire, but he wired him, I believe, like it was in order of like $4 or $5 million. And the way that he got it is because he had everything that the guy needed to invest in one email. So the points I'm making is everything that you need for somebody to invest in you should be ready for, like as early as possible with as little steps as possible. So basically what I'm saying is you should have a website where when they opt in, they get we call it the data reel. So all the documents, all the things that are needed for somebody with the wire instructions and everything. If you go to Grant Spardone's website, you pretend that you're an investor. They will send you everything that somebody needs to wire the funds. You get the wire structure, get the papers and all that stuff. So I would have basically have a way to be paid. And if somebody wants to pay you and then they're not able to, then you will never raise money, because how can you raise money if there's no way for them to, if there's no way, you don't have any way to take money. So it's impossible. Like, so I'll just have all the things that are needed to take money for an investment. That's one thing. The second thing is credibility. It's like, sure, like what I'll do is I'll make sure I'm an expert in my niche. So anything that you're raising money for, I will make sure that you know what you're doing. So like if somebody's raising money to do we had somebody's doing government contract, raising money to buy government contractors for cybersecurity, things like that. He works as a cybersecurity consultant and he did it all his life. So that's why he's able to raise money for that sort of thing, because that's what he's been doing all his life. If somebody's raising money to do a hedge fund and then they've never invested in public stocks, why should they raise money to do a hedge fund? So ideally, it's key that the person who's raising money for the thing is the person who's done the thing themselves. And if the person that isn't the person that's done the thing themselves, then they should get people around them, i.e. a board. Dan Pina, all the Dan Pina folks are going to say a board of directors. Sure, you can do that. It's really affordable. You can get people at a quarterly meeting that sit down with you and say, hey, look, I'm going to sit down with you every quarter in exchange for, you can do it in exchange for an option to invest at the same rates as other investors or at a cheaper rate than other investors. You can do that. You don't pay a cent in doing that in exchange for a quarterly meeting. So, and then you can put them as your board of advisors. If they don't like those terms, you can go further and say, hey, I'll give you, I hate to say the word, but I'll give you some equity in exchange for, all your time that you spent, to vest it out over a certain period of time. The reason why you want to vest it out is because you don't want to give people equity up front for something that you don't know that they'll commit to. Obviously, contingent on funding. So if you do those things, then you can get people around you that'll be interested in investing with you. And then after that, if you have direct team members that aren't board members, if you have a business partner, then that could be really good too, if they have the experience in the thing. That should probably keep you busy for a while. So those are some things that people should really get ready if they want to build credibility to take investment from people along the way.
Like, what if they don't have a deal right now, but they're looking to buy a business, let's say in 6 to 12 months? Do you suggest, they should start working on it like today, so that, they have everything, let's say 6 months from now or something?
Yeah. And it's not so much about finding the deal. It's about knowing what type of deal that you want to invest in. So, because in many cases, you can get somebody that will fund your limited partnership if they know the type of deal that you want to invest in. So let's say I want to do fix and flip in let's say I want to do fix and flips in Wellington, Florida. And I only want to do fix and flips of like a specific type of, I have a really specific buy box of the types of deals I want to do. Yeah, then certainly you can get people to invest into that type of deal before you have the deal under contract, by either showing some form of interest or by getting them to even sign the subscription agreements and get first access. So that's a way around the whole thing of, I need to find a deal before I take money, And the model I found it worked best in is fix and flip for whatever reason, because they think fix and flip, subject to deals, these real estate deals that are at auctions that go off the market quickly, because those deals go off the market in hours. So for whatever reason, those types of deals seem to be the best to take money ahead of time and, use it from people. So I suggest those types of deals.
What does the messaging structure looks like when you're reaching out to someone, to an investor, when you don't have, anything, you don't have any deal on the table? What does it looks like?
I guess the first step would be never to think that you don't have anything to offer. What I would say is, and this is how I got into this whole money raising thing. It's really funny. So the way I got into it myself personally, and I think the best way, you're not selling. It's kind of like the Wayne Gretzky saying, it's you don't go to where the puck is, you skate to where the puck's going. So you just say hey, I have a pipeline of this many deals that exactly fit your criteria. And you can't falsify it. You actually have to do it to some extent. Don't sell them on the deals that you have, sell them on your pipeline and say that you have a pipeline of X $million of deals that specifically fit this. Would you like them? That's pretty much it. And then just focus on what you can give them instead of what you want. And then they have to say either no or yes. If they say nothing, then that means they're probably they don't trust you for whatever reason. And then that's pretty much it. I sense, and I think this will help somebody, but what I did is I sent a bunch of emails to a bunch of startups that were desperate to raise money in cryptocurrency, right? So I had an email list of a bunch of companies that were desperate to raise money for their cryptocurrency deals or whatever, right? And then I went to an investment bank and say, hey, listen, I have all these cryptocurrency companies that are exactly what you guys help fund, and they're all desperate to raise money. Could we have a sort of an arrangement where, we can close the deals through your company? And then it worked. And then I got all licensed up, and then we started doing investment banking and closing some deals. All because of that. And it was all just a bunch of LinkedIn messages. And then this is a real thing that really happened. And, I flew to Toronto, and, it changed my life and everything. So my point is find somebody that is really specific about the types of deals they want to do. So very specifically, I would say, hi name. I took a look at what you do at company name. And when I say all these name and company name, just imagine that there's we call it mail merge for those who aren't familiar, or personal tags of the person's information that you manually or automatically put it. So you say, hey name, I'm impressed by the work you do at company name. We have a pipeline of X million dollars that precisely fits the types of deals you do at company name. Is this something you'd want to learn more about? That's an example. So you can replace learn more about it with see more information on, et cetera, et cetera. Just something like that. I'd run that and see what that gives you.
Awesome. So in terms of call to action, is it always hey, do you want to know more and things like that? Or do you have any other call to actions, maybe to book a call or something like that?
I'll just do book a call for those people, because sometimes those people, especially the ones in New York and stuff, they just like a phone call. They're just so serious. They just like a phone call. I'll do the lead magnets work more for these mom and pop shops and the smaller investors. But if it's the serious institutional guys or the serious guys, I have to say when it works for a call, and then and then I'll have the calendar. I would have the calendar link, but I wouldn't force them to use the calendar, because sometimes these people are 50-year-old people with they think on a different level. They just make a phone call to somebody right away, even if you don't know you. They're oh, hey, this is if I give you a phone number of some of these people, they'll answer it, and they'll just be, hey, yeah, what do you have for me? And then you have to tell them, and then they just say no or yes,
So the messages you're sending, is it are these messages being sent once they've accepted your connection request?
Well, you send the first message to connect with them. The goal of the first message is to get them to accept the connection request. So what you're doing, to be clear, is instead of learn more, I would say, hi name, impressive job at company name. We have an X million pipeline of insert niche here relevant to the prospects. Let's connect, name, because the goal of the first message is connect. And after you connect, then you say, hey, and then you just say, you kind of repeat yourself, and except with the connect, just say learn more. So replace connect with learn more. And then you just follow up. You just say, hey, do you get the last message? And you say, oh, and hey name, you send multiple, after every day, you just send another follow up. And say, hey name, question mark. That's really it. These are name question mark. And then you're yeah. And then you start replying. You're pretty simple. And then you do a Hail Mary, you in the, I think 2 or 3 days, you say something what will be the last one? In between, usually in 2 days, you would say something oh, hey, you seem pretty busy. I just wanted to offer the opportunity before, because other firms are asking for it. So you want to kind of make it seem scarce by saying that there's other firms that are looking at your pipeline of X deals that fit their criteria exactly. And then that one usually works to get them back. And that's pretty much it. And sometimes what you will do is if there's an interest, we get somebody to outbound call. So if they say something, let's say something yes, I'm interested, and then you have the information for the phone number, you just do an outbound call. They'll answer sometimes, and then you qualify them on that outbound call. So that's what I'll do. And then you say, oh, and then I can run through a script on the outbound call, but you're ideally referencing that initial links and request attempt, because then they have a reason to be reached out to. And after we connect, then we sell the call. Because if we're just coming with a call, then they'll be okay, this guy just wants a call. But if we connect and we sell the connection, they start seeing all the mutual connections. They're oh, okay, that'll grow my network. So because I can get the connection request percentage from 3% to upwards of 7 and 8% even. Then you can never, because the issue of all those lists is that it's okay, how did you get in touch with me? How did you find my information? Then you're like, I don't know. And then you get scared. But in this one, it's just like, okay, we connect with you on here, so like, what's up? And then you have like a reason to talk to them.
Real quick, guys, each of these episodes represents over 30 hours of my personal work, not including my post-production team's time. I'm building this podcast to become the number one resource for business acquisitions, and the only way that's going to happen is through your feedback. So please drop a comment with a timestamp for the parts that you found valuable or not helpful. If you're on audio platforms, you can leave a review. This will help me understand like what you like, what you don't like, so I can create exactly the content you want to see. Thanks for your support. Now back to the podcast. So now we know what the messaging structure is going to look like when we don't have anything, we don't have any deal and stuff. So what does the messaging structure looks like when we have a deal under LOI? Is it going to be the same? Is it going to be different? Like, what does it look like?
Here's the thing about having a deal under LOI. I mean, you're probably underneath a little bit of pressure because you need to make sure that you can actually close the deal, or else you embarrass yourself in front of the person that's selling their business to you. So I would keep it this, like, more or less this, like, if it really works out, keep it the same. The only difference is maybe instead of saying pipeline, you just say, I have a deal right now. There's a transaction right now. If it's a mandate, that's the main difference.
So is there anything else you like include in the message? Like, I don't know, like a one page about the deal we are working on and things like that, or a pitch deck, you could say?
The quick answer to your question is we just have like a short summary that is vague enough to solicit interest, right? And then after they book the call, then we send everything to them that is needed for them to wire the money, to learn about the legalities, to do everything that is needed. So that's what I would do.
Can you give us like a quick example of like what it would look like? Because just with let's say we have a deal and stuff, like what is the connection message is going to look like, and maybe the first message, like just to know the difference, what it looks like.
Okay, so one of our clients acquired a metal fabrication business, for example, and something that we coach them is to say something like this. So similar to the beginning, to other things we were discussing, we have the connection message. The goal of the connection message is to get them to connect. So we connect with them. We say, hey, hi, name. I see that your company is in niche. We have a deal in niche that is generating this much in revenue, X million, and just insert the amount in revenue. Let's connect niche, let's connect first name, and then you connect, right? And then after you connect, 15 minutes after that connection request, if there's no reply, to say, thanks for connecting first name. I saw that your company is in niche. I have a deal. It's pretty much the same thing. It's like, I have a deal that's generating this much revenue in niche that fits your insert company names mandates. How can one see if there's an opportunity? So that sentence is just to try to solicit like a call or something. Or when works for a call, so we let people choose how can one see if there's opportunity, or when works for a call. When works for a call is better. And I say, if not, so another line that some people added that we have in the scripts, if not, and you're satisfied with just connecting, happy to have you on here. And the reason for that line is to remove the people that get angry if you send them a connection request just asking for a pitch. There are some people that get angry at that. So that's just to calm them down. And the second one's really straightforward. Is just like, first name, got my last message, and then that's just one day after. It's pretty much nothing. So, and then one day after that, if there's no reply, it's like, hey, first name, our team has been involved with companies in insert niche fitting your exact mandates. Are you too busy to discuss? And so you're just like, teasing them, like, and then trying to get them to book a call. And then the next one, 2 days after the previous message, if there's no reply, hey, first name, I took a look at your company. So insert company. I took a look at your work at insert company, and I have a question. Would you be open to discuss? So you're just keeping it vague, and you're just trying to like get them itchy to see what's going on. And then the next one is 5 days after that previous message is simply first name, question mark, just to reactivate them. That's mainly it. But then there's one final one. Is more of a Hail Mary. It's just, really it's just 2 months after. You're just saying, oh, how's business, first name? Like, that's pretty much it. And the goal is to book a call. And then when we book a call, we send them all the information about the deal, including like, obviously there's like an NDA before that, but the goal is to get them to get all the information that is needed for them to actually consummate and close the deal after that first discussion.
You mentioned in some of the podcasts you were on is like you got to be very careful with the words you use when you're marketing it. It could be with paid ads or it could be with messaging. So can you give us a quick, maybe few examples of the messages we should not be using when we are, reaching out to investors through LinkedIn?
Yeah, I mean, I guess there are things that you shouldn't do from a legal. There's a legal shouldn't do, and then there's like a sales shouldn't do. From the legal shouldn't do. See, here's the thing, right? Like private messages are a bit easier because if somebody's raising money and they're not an accredited investor, like it's easier to get away with. Long story short, it's easier to get away with bad practice in a DM because nobody is not public information unless the person discloses it to somebody. So that being said, you still have to be careful. Like you can't say in a perfect world, you shouldn't say the terms of a deal if you don't know if they're accredited investors. In a perfect world, you see a lot of people breaking this convention, but in a perfect world, you shouldn't do that. So ideally, you just say information that you say all the terms of the deal, all the information about the deal, all the instructions to get for the funds to be wired, only if you know that they're an accredited investor. So that's why when they book a call, there's a disclaimer or a checkbox that says, I'm an accredited investor or, whatever, all those disclaimers. And then after they see those disclaimers, then you can go crazy. So ideally, you're just talking about the money it could make people in general. And then you're confirming that they're accredited before you get them the terms of the deal and the wire instructions. But if you send the terms of the deal and the wire instructions to somebody that's not an accredited investor, then they send the money and they're not accredited, then you're going to be in trouble. So it's really serious. So that's on the legal shouldn't do. On the sales shouldn't do. What shouldn't you do from the sales perspective? Like just focus in general. I guess the principle is just focus on what's in it for them. They don't really care about how hard you work. They don't really care about you. They just care about what they can make it from you. So as long as you just like obsess about the investor or the funder and forget about yourself, then you like just be in service to some people. Like one problem that so many founders and so many people have is that they focus and obsess about what's in it for me. Like they focus on me. And then they're just self-obsessed, but you have to be obsessed with others and with the customer and with the people. And then if you do that, then, just say what people want to hear and back it up with proof. And then that's all you have to do.
So let's say someone responded, said interested or something, and then they stop messaging you or stop replying to you. So, but like, do you use the same follow-ups? Or if you use the same follow-ups, like, do you have any, like, how long do you normally follow up with people like that? Let's say they said interested, but, they started ghosting you. Like, how long do you follow up with them before giving up?
Yeah, try the multi-channel approach. So, you want to really, really multi-channel them. So, if you really want to go crazy, so what you want to do is like more often than not, they have the, on the automations, you have the email, you have the phone number. So just hire somebody or you yourself outbound call them and say, hey, I saw that we connected on LinkedIn about an opportunity in niche. You said that you're interested. Do you have 5 minutes to discuss? They say yes. And they say, okay, just to make sure that we're singing from the same hymn sheet and then all our interests are aligned. Are you allowed as an accredited investor to see these types of opportunities? Yes, no. Okay. And you're open and willing to do this, right? Yes, no. Okay. So let me tell you about the opportunity. And then you just go on about the opportunity. So my points in a nutshell is just saying that, hey, you can just give them an outbound call. You can give them an email if you have an email, using the excuse that it connects on LinkedIn. And you can even feed all the data, if you have the data, to Facebook retargeting, LinkedIn retargeting, because all these tools let you, and even YouTube and Google, you can send all the emails to an ad platform that allows you to retarget people so that they're seeing your company everywhere. And that's how you get people to think about you all the time if they don't reply to a message.
It's almost like build an ecosystem and keep like retargeting them until they become familiar with your, whatever brand, and then they could come back and invest. Yeah, that's a good way to think about it. And like once someone responds, like normally we get 3 responses, with all the follow-ups you do. Maybe it could be interested, hey, I'm interested in knowing more, or, booking a call. Or the second could be, I'm not interested. And the third could be like, hey, 50-50 maybe in the future. So I mean, if they are interested, I'm pretty sure, you just book them a call, get them on the call. Like, what if they say like, I'm not interested, or maybe in the future, what does it look like? Do you just remove them from the list, or do you follow with them in the future?
I just give them free lead magnets. I give them free lead magnets, gives them free stuff, free webinars, whatever. It may be manual. I won't really force a lot of automation into that. I'll just try to get them free lead magnets to opt into an email list. Just so that, you're keeping them warm. That's what I'll do. Because sometimes like 3% of any given market is willing to, invest at any given time, whether or not they even have dry powder. So, it's very rare that you see somebody that's ready to fund the deal right away. Most people are, it's the timing. It's actually, everything's perfect. It's just the timing is off. So just get them in an email newsletter and let them know about what you're building and keep them warm, give them things that are of value. And to be specific, I would just say, hey, we have a free webinar on how a firm similar to yours acquired like 8 figures in deals similar to this. Here's a link to sign up to the webinar, or basically just focus on the outcome of the target market and offer specific things that they can read, things that they can listen to, things that they could attend that explain how they can get to their desired results. So it's kind of like even like it's basically sell them, give them free things that they would like to attend or consume that show them getting the result that they want. And then if you do that, then they'll come to you for free. And when they're ready to invest, you have their email and you have email blasts that tell them to invest, so that you have that. That's how you build like these things that, oh, we raise 1 million in a day, whatever. Like that's the realistic way of doing it. Do that for 2 years, and then you'd be able to raise 1 million in a very short amount of time.
Yeah, that totally makes sense. So, I mean, the other way about, the way of finding these investors is like, as you mentioned, is paid ads. I think I read few success stories in the razors.com, some of your clients' case studies. So, I know there is a lot, like the running paid ads and running, the LinkedIn stuff is completely different. So, like, who should do paid ads?
Sure. And paid ads are very, like, you have to be the type of person that is really, like, if you're running the paid ads yourself, you have to be the type of personality, in my opinion, that is extremely detail oriented, extremely scientific, and extremely peculiar, like borderline obsessive compulsive disorder level. And I'm not even being facetious. This is actually what is required sometimes, because the level of detail that is required, to track your numbers, to track the return on ad spend is meticulous. So if you're not the type of person that's super meticulous, then it's best you just hire somebody to do it. Or you rely on organic. Also, if you don't have the money, because the thing is that you can actually lose a lot of money with paid ads. The thing with LinkedIn, the reason why I recommend it to most people, LinkedIn, and some people recommend email, like a lot of my competitors will recommend email or LinkedIn, is because it's very cheap. It's very affordable. You can make mistakes. I think if you have a successful time with organic, and when I say organic, I really mean outbound organic. So in other words, I mean sending messages to people. It's a very B2B thing that is very cheap. You can afford to make the mistakes in sending messages that are free to people, as opposed to spending thousands of dollars to Facebook and Meta and Google and, even all these other platforms, before you have results from organic outreach. So in a nutshell, get success with organic before you go out and use the paid ads, if you want to rate the paid ads yourself, or partner with an agency that is really good at doing paid ads specifically for investors. Because if you're not the type of person that is really detail oriented, you will lose a lot of money.
Are you guys like run paid ads for your clients, or you just do the outbound stuff?
We just do the outbound stuff. I mean, we referred people to different agencies that we partnered with that do the paid ads. And funny enough, some clients have actually come to us in the past. There was one in particular. He's a doctor. He's a doctor based, I think, in Houston. He's one of our earliest clients. He ran paid ads. He had a VC fund for doctors that wanted to invest. And so he ran paid ads to that funnel, and he ran webinars, and he raised, I think, $100,000, every like few weeks. And it actually works. And he did that for quite a while. There was another person in Sarasota, one of my good friends. He ran a company called Short Term Sage. Julian Sage is the guy's name, and he was in based. I just met him in Florida, Sarasota, like last month, and he ran paid ads to a real estate fund and successfully raised somewhere in the mid six figures with Facebook ads, just using basic But the thing is that he's the type of, I mean, he used to be in the military and he has a really sharp personality when it comes to knowing the numbers. So if you're not that type of person that has a sharp personality and knowing the numbers, at like extremely, and I'm not exaggerating, you have to be very, very meticulous. Then you can run paid ads really successfully. And I guess the last example is I have my good buddy Andrew Damon, who's he used to be in law enforcement and so on. His business partner ran Facebook ads, and they raised. And I always hear the same story about six figures being raised through Facebook ads. So they ran Facebook ads, for their real estate deals as well, the fix and flips, I think, and they had a lot of success with that. So all in all, I hear the Facebook ads work. They do work, but they work for small check investors and they work for small funds and many times real estate. But you just have to be very serious about it in terms of the numbers. So if you don't want to take all that pressure, then I just start with organic first, raise your few bucks, and then use some of the money from the initial organic raises to go out and do ads. That's what I would do.
So other than leveraging paid ads and sending LinkedIn connections, to get what do you call get familiar with these investors, or get in front of them. Are there any other ways you leverage, to get these investors? Maybe like getting warm intros or things like that.
Yeah, warm intros so even before we go into this, the whole discussion about cold, warm intros are the best way. They are the best way. The thing is that there are two ways to get warm intros. You know somebody, or somebody introduces you to somebody you know. So the best way to get warm intros is to find people that are in the business of doing warm intros. I mean, these are just consultants or investment banks. And you can incentivize them to give you the warm intros by offering them part of the upside. So offering them success fees. So the issue is that the Securities and Exchange Commission, which regulates this type of activity to protect investors, they are really annoying in terms of making sure that people don't do it the wrong way, which is good, but it's bad sometimes because it makes it hard to do business. But it's good because it protects investors from people recommending deals that they have no business recommending. So what people should do is either, find people that know people and offer them a success fee if they're legally allowed to take that success fee. Success fee just means part of the money raised after the deal closes. Offer them a success fee, or find people that are good employees that already have a book of business of investors. One of the investment banks I worked with did this exact thing. He raised $1.5 million in 2 days. He already had a book of business. He already had investors he knew. He already had investors that he transacted with. He just became an employee or a contractor. I believe it's employee technically that you have to be of that company. And then that's how they got a lot of contacts. So that's probably the best way is hire somebody that already has a book of business, hire an agency, in other words, an investment bank that is in the business of doing these types of introductions. But funny enough, a lot of those investment banks, they do the same things I recommend. They just go on LinkedIn and trust me, there's one investment bank that paid $25,000. They just do the LinkedIn thing. It's crazy. But anyways, back to the point is, get people that can do the introductions and pay them a part of the pie for it, or do it yourself. So those are the two ways.
I think one of the thing that's going to be missing when we are looking at warm intros is you don't have control over it. I mean, they could send the intro today or they could send the intro a week from now.
I'm not against warm intros. And, but the thing is that I'm just against depending on only one thing. So I would rather start doing the warm. I'd rather just do everything. I'll do the warm intros. Now also start doing the cold stuff because both work. So I don't want to say, okay, let's depend on a warm intro. And then you depend on one guy to close one deal from one intro. And then you put all your hope in one guy. Instead of doing that, I would just try to have multiple things. I would have multiple people doing warm intros. I would have multiple ways of doing cold traffic, just so I'm not dependent on only one thing at one time. Because then, I don't think it's smart to be naive enough to think that only one person can close a deal that you don't even know that well. So I would just have multiple sources of conversations coming from investors at all times, as early as possible.
So you mentioned success fee. Of course, success fee is once the deal is done. Do you pay anything upfront for this introduction, or is it only completely dependent on success fee?
One can do whichever the vendor is charging. Like the vendor is the person that is the person offering the service. So I mean, it's up to the vendor to say what the prices are, and usually, they end up asking for both. Like, I mean, I know some investment banks, they only do success fee, but their minimum deal size is $25 million, and they won't touch anything below that. And they have to have good management, and they have to just subjectively agree to it. I know some others that would do a fee up front, and barely any success fee. And I know some that would do, you know, like it's just all over the map. So the quick answer is, yeah, like people, it's all over the map. I would just not do the ones because we know of some companies that they charge like $100,000, $200,000, and a success fee. And I've seen people get no email replies after that. So I would just really be careful with what company that you use. Depending on what they're asking from you.
So I think one of the thing you do with the Calendly is like, as you mentioned toward the podcast, is like have those qualifying questions, before they even book a call, with like a form, they could fill before they book a call. So can you give us like, like what does those questions looks like, so someone can like model after?
Yeah, sure. So one is you want to see the intention, if they're open and willing to, like, to see if they're open and willing to invest. So you have to see if they're open and willing to invest. Because if you book a call with somebody who's not, and then what's the point? So are you open and willing to invest? Yes or no. It's a Boolean, right? And then the other one is, hey, when would you be looking at doing something like this? Would it be, as soon as, would it be like in a few weeks? Would it be in a few months? Would it be like next year? Because a lot of people are open and willing to do it, but the timing is usually off. So you just get the timing, and and this is basic qualification. If you look at, I think her name was Barbara on the Shark Tank show. She said that when she made her first few million, she literally just said, and she did real estate. She literally just said, hey, are you looking at doing this now or in a couple of months, or in a couple of weeks or whatever? And then everybody that said a couple of weeks, she didn't even take those calls. So anyways, so basically we're getting are they open and willing to do this? And then what's the timing? And then we want to see if they have the, like, what are they looking to put, how much money? So like, we give them a few ranges. So we say, hey, below 20K, 20 to 50K, 50 to 100K, 100K plus, 1 million plus. So that's one standard range I put. This is a radio button. Radio buttons have lower friction and drop downs. So if you want to have low friction, use radio buttons instead of drop downs. And then the last one is just, are you by continuing, you're an accredited investor, something like that. Like by continuing, you understand you're an accredited investor subject to, so-and-so acts in the SEC, so we just have like a link pointed them to what the SEC defines as an accredited investor. And then we have like a checkbox that's there that says, hey, by continuing, you're an accredited investor. And then when they click on the thing to book the appointment, then they get forwarded to, ideally the clients that use Go High Level, so they get sent the entire data room, or I guess the NDA first. And then after that, they sign the NDA, then they get access to the entire data room of all the information that is needed to see the investments and then to wire the funds. And then they also get automations and reminders telling them, hey, your calls at so-and-so dates, kindly review the documents here and here. And it's really just a basic Google Drive or Dropbox. Usually just basic Google Drive. We don't need anything too fancy.
So is there any other, like based on their responses, like, is there anything, that would make you like cancel those calls? I'm pretty sure like one of them is, if they're not an accredited investor, like other than that, like, is there any other responses you might feel like it's not worth having a call right now?
Like, I mean, depends on your pipeline. Like if you have like a lot of calls, then you can get picky. But if you have no calls, I would just take the call, because I mean, if beggars are not, we can't turn beggars into choosers. So, I mean, if somebody's having like a really slow, week or something, then it can take a few calls of people that are less qualified. I definitely won't take a call of somebody who's completely not willing to work in the entire business model to begin with, because then you get people that are raising money for their own deals, and then they come to you saying that, oh, we need to raise money. So it's just two people that want to raise money that are bashing heads against each other. That happens a lot. So as long as they're open and willing to even engage in the business model of investing, then it's relevant.
Now the investor has filled the form and you have sent the reminders and stuff. So the next call they're gonna have, like, what is the main goal with that call?
Oh, the main goal is to go through the sales process and then have them make a decision. It's crazy because some people would say, oh, the main goal is to get them to invest. The main goal is actually to get them to make a decision, whether it's they're investing or not. And so we're not going to even split things up into a qualification call or not, because we're going to just have it just for the sake of simplicity, because the amounts of effort that goes into having two different calls, two different tracking sheets, two different KPIs, two different show rates, two different like objection sheets, for each of the calls is definitely too complex for somebody that just has a few links to the accounts that's getting started, in my opinion. So I definitely recommend just having one call, and it's very likely that the call will end in a follow-up if they're not ready. And at the beginning of the call, if the person isn't qualified, if there was no qualification process and it was a cold call, all you're doing is just going through the qualification questions on the phone. But long story short, the goal of the call is to get the person to make a decision on whether they're investing or they're not investing.
Like, how long does this call is gonna be? The first call with the investor.
Usually really short, actually. Like, the more B2B they are, the usually shorter it is. So usually like just probably 20 minutes, and then sometimes it ends with a follow-up. Sometimes the calls can actually be long, like up to like 45 minutes and beyond. But that's if everything just lines up right, and then, they have time, everything just lines up and they're really interested.
What is the scripts looks like, for calls like this?
Oh, sure. So pretty much what do you want to do? First, you want to establish rapport and just say, hey, nice to meet you. How's your day going? Great, amazing. You going great. Say, okay. And then you want to set agenda. Say, oh, the reason for this call is, and then you just say like a brief agenda. Depending on here's the thing about it. Like, we don't follow specific scripts as much as frameworks. So if the script is really sharp and really like if it's like somebody that has a lot of authority and the person has status delta over you, you don't want to be as like controlling and overbearing on things. You want to be more, dare I say it, not submissive, but you want to be more amicable in the sense of like, okay, hey, usually the way we like to do these calls is, like this. Whereas if it's somebody that you have a lot of status delta over, a lot of authority, they trust you a lot, it's like, oh, the way that this call is going to go is like this. So you want to just be careful with who you're talking to, and know, like, you don't want to be talking to somebody who's like a multi-million-dollar CEO who, with like a child, if they don't give you that authority. To answer the question, so we have the, the connecting parts where you build the rapport, how's your day going, great. Light setting of agenda, and then you want to go into the intention for them booking the call. So, okay, so what was the main motivation for you booking this call? Or what was the main intention for you booking the call? And then they go into what they're looking for. And then you say, okay. And then the next part of the call is just to understand really their mandate, to understand them. Say, okay, so what are you exactly looking to do? And then the call from here can kind of go into one of two ways. Usually it's really quick and them just asking you what you do. So that's usually if they have a lot of authority, if they're more institutional investors, and so on. The second way it can go is more of like a B2C call. If it's like, if they're more newbie investors that are doctors that are more submissive to you in the sense of not knowing where to invest, So the more advanced type of prospect, you just tell them you just ask them what they're looking for, and then you just say what you offer within that first 15 minutes. And then after that, you ask them, are there any questions, or is this something that you'd like to move forward with? And then usually they say something like, yes, you have to take it to X, Y, and Z board, X, Y, and Z partner. By the way, on the qualification questions on the calendar, one of the questions is, when can they decide? When could them and their business partners decide? Because one common objection that prevents people from getting their deals funded is because of deferring authority to another person to make the investment decision. It's very common. It's normal. So sometimes what you want to do is expect people to, even if they are qualified for a decision, that they're the decision maker, you want to make sure that you get ready to deal with that objection. And then the way that the call has to end, it has to end in either a yes, it has to end with a follow-up time set, like booked on the calendar. So while you're on the call, you're booking the follow-up call, or it has to end with a no. So that's how the serious calls go. But the more B2C type of calls, usually what you're doing, you're more diving into the person's problems to see, oh, why aren't you making this? Like, like what? Basically, you're finding their problems a bit more and pushing into their problems to see why are they looking to invest, how much money do they want to make. So you dive into the problems, then you dive into their desired situation, their desired outcome. Say, okay, you're currently making this much passively, and then you want to make that much passively, and then you position yourself as the vehicle to get them to that desired result. So you really want to like push them on the problems, ask them what their dream outcome is, and then position your vehicle, your investment vehicle, as a vehicle to get them to that desired result. You can do that more of the B2C prospects and the B2B prospects, like especially the ones that are really quick. But that's pretty much it in a nutshell.
So, do you even like talk about like the deal you have on the table, or you don't talk about the deal you have like in that on that specific call?
You do to the extent that they're able to listen, because sometimes like on these calls there needs to be a follow-up. Maybe you just have 20 minutes and maybe they have to go. But yeah, you want to talk about everything you can about it.
So, like, what if let's say we don't have a deal and we booked on a call. So, is it gonna be just like understanding what they want and then maybe add them to a nurturing list or something like that, or what does it look like?
It's really just more about you have to be ready to accept money. So some people, they have a vehicle that can allow them to take capital in from investors to go out and seek those type of opportunities. If you're able to do it, then do it. Then just say, hey, we're ready to take investor capital now to invest in so and so type of deal. It's more of like a almost blind pool fund, but not quite a blind pool fund. It's like you have a specific buy box of the types of deals you want to do, and then you say, hey, this is the type of deal that we want to do. Here's a subscription agreement. Here are the PPMs. Here are the documents. Like we can proceed with the next steps if you like. And then try to get them to make a decision on that. So you can take capital in if you already have the documents ready. But if you don't have the documents ready, then just say, okay, we have a lot of spots available. You want to use the principles of urgency and scarcity ethically. You want to you deliberately have a way, and obviously talk to a lawyer, but you want to make sure that you leverage the urgency and the scarcity of your investment opportunities, because there is a real urgency and a real scarcity to your investment opportunities. Make sure that you say, hey, listen, there are potentially a lot of people that could be interested in this opportunity. I want to have you down as one of the first people. For that, we just need to make sure that, we have an agreement between each other. And then what you want them to do, you want them to, they can make as some sort of, you just have a lawyer draft some sort of document saying that they will have the first opportunity to invest. Even getting them to sign a subscription agreement, if your lawyers allow you to do so, then you've gotten that's what we call a soft or hard commitment. Worst case, you just get them to have some verbal or written commitment saying that I'll commit to invest in X amount at X terms, at a terms that are better than everybody else, so that they have incentive to move forward with your deal when you do find those opportunities. Then you've gotten a soft or hard commitment. That's pretty much all you have to do. Just get them to say that they're going to invest at the special terms that you've given them, because they're one of the earliest ones on the list.
Once we have done this first call, maybe like 20-minute call, we had a conversation and stuff, and let's say they were interested in knowing more. Like, do you get on another call like and pitch them on the entire deal, or like what does it look like?
Well, if you're able to pitch them on the entire deal, pitch them on the entire deal on one call. Most of the time you're not, but if you're able to do it in one call, then you do it in one call. If you're not able to do it in one call, then do it in multiple calls. Because if somebody is ready to invest now, why delay it? Right. So you want to do as much as you can in one call, So then that's kind of the strategy. But then, as you said, then the next step is really just you continue off from where you ended, where you stopped on that first call. So usually the way that sounds like is really just almost like an open Q&A of you answering questions about the investment opportunity. And then you handling their objections. An objection is just a reason why they won't move forward in a deal. So if you go through all their objections, the idea is to turn the no's to maybes, maybes to yeses, yeses to signature signed. So you just want to go through as many, many, many objections as you can, reasons why they won't move forward or questions that they have. You want to answer the questions as best as you can. And then you want to get the underlying reason as to why they're not moving forward. Because some people can say they're not moving forward because of X. More often than not, they're not moving forward because of why. For example, somebody doesn't move forward. It could have nothing to do with your deal. Maybe they just have like a cash flow issue on another one of their portfolio companies and they're not telling you. Somebody can say they're not moving forward because they don't, people are not really straightforward, unfortunately. People are not really straightforward. Not because people are liars, but because people are just, driven by ego, driven by image. And there's no need for anyone to tell you anything. Like don't owe you any explanation. That's one mistake founders make. Founders always think that everyone owes them an explanation. Nobody owes anybody anything. So what ends up happening is somebody will say that they're not really going to move forward, and then they won't get an answer as to why. So what you should do as to the prospective investor, just make sure that, you don't be pushy and you build trust with them. And if you build trust with them, then they'll continue to be transparent with you. If you lose trust or rapport with them, then you will lose that transparency and rapport with them. And then once you lose that transparency rapport with them, it's more likely that they'll object to investing with you and you won't know why. But if you build trust and come from a place of trust, then it's more likely that they'll be more transparent with you as to why. And this has to do with one of the rules of human psychology of the fact that we're really reciprocal creatures. If somebody is honest, open, and transparent with somebody, it's likely that they'll be the same way back to you. So the key and the solution at the end of the day is just to be open and transparent and honest with somebody, adding value to everything that they do. And then if the person is of decent moral character, who you want to do business with anyway, then they'll end up being transparent with you in the reasons why they're not moving forward with your deal. So long story short, in one sentence, you have to be very skillful in finding the underlying reason as to why somebody doesn't want to invest with you. That's all.
So let's assume, we are building the trust with the investor, we are being transparent. And for some reason, you feel like, like whatever the objection they gave might not be the correct objection, they might be hiding something. Like, how do you go about, finding that like real reason, like why they are not willing to move forward?
Sure. So you have to isolate it into, so one of the classic ways is like, okay, this is almost cliche, but hey, it's on a scale from, you can say, if this is really cliche, but this works, say on a scale from 1 to 10, 10 being, this is the perfect investment opportunity. And 1 being, this is, I just want to get off the phone because this is the worst opportunity. Where would you say the opportunity lies? And then if they say something that's 8 or greater, then you say something like, okay, great. So now that you know that now that the investment opportunity is mostly what you're looking for, aside from the investment opportunity, what else could be, preventing you from making this decision, to move forward with it, and then you can do that. And sometimes what ends up happening is you just want to, basically what you want to do, you want to get you want to see how good your product and your investment opportunity is in their eyes, because that's like one world, right? And then the other world has to do with them trusting you. It has to do with them feeling right. It has to do with them having, like, basically has to do with them. It's basically and then that's more dealing with their beliefs. Because once the actual opportunity is good, then you're dealing with more of their beliefs. And it's more of like a psychological thing of them dealing with their beliefs. So in the way that you deal with their beliefs and things like that is more just you kind of coaching them through why they believe what they believe, or because, and people can just say, hey, the reason why I don't want to invest and I don't want to move forward, that has to do with this partner and that partner and that partner. So you handle that. It could actually have to do with the terms. So the deal can be good, but it has to do with the investments and the terms of the deal. And if you can fix the investments and the terms of the deal, and you're not so rigid in the terms of the deal, and I know I said the opportunity, but sometimes the opportunity is perfect, but the terms are not. So sometimes you just have to work with the terms of the deal. And let's say, hey, it has to be a lump sum investments of 100K. They only have 50K. They don't know if they'll have 100K. You can just take 50K and make a side letter for them with a lawyer and say that, hey, that's fine. Like if somebody wants to send you 50K and you wouldn't take it, sure, good for you. But many people will take it and invest it properly. So it could be something to do with the amount of money. And then the last thing that's really rare, it could actually be a logistical reason. Like there could literally be a physical reason why somebody can't invest. Like maybe they're switching banks. Maybe there's actually a logistical reason. And so in those cases, either you fail or you succeed in coaching them through their beliefs that are preventing them from thinking that now is like a good time to invest, or you deal with the logistical reason or the terms to make them fit the situation of the person. But as long as I think the hard part is, especially in an investments or a B2B thing, as long as you get them to understand the opportunity, to make sure that the opportunity is good enough, then you can isolate the reason as to why they don't want to move forward.
So it's almost pretty much like typical sales. How you like sell a like how we do high ticket sales. It's almost the same, but here we are getting capital and selling our deal rather than a product.
Yeah, exactly. It's the same process.
Yeah, been telling for a long time, from the beginning of the podcast is like, hey, you have to nurture these leads, Uh, so when it comes to nurturing, I'm pretty sure you use like an email newsletter, if I'm not wrong, to nurture these leads.
Yeah, you use other, and YouTube's are pretty good.
So, question with the the question with the the newsletters to nurture these leads. So, do you like have them? Do you send them a link and say, hey, with the lead magnets, have them subscribe to these newsletters, or do you just add the email list you have directly to the newsletter?
Okay, so yeah, usually it's a lead magnet. So either run ads and then opt into lead magnet, and everybody that's one way. Everybody that also books a call also gets added to the lead magnet. So it's either from the ads or from everyone that gets added to a call to a lead magnet. Another way is having all the contacts that have not booked a call or have not opted into an email newsletter is to send them a cold email. So you're not using the email software for newsletters to send them a cold email. You're using another piece of software that's meant for outbound emailing, like instantly, to pitch them to join the email newsletter. So it's a bit annoying because you can just add a bunch of people to the email newsletter. What will happen is like the response rate goes down, and then your email always goes in the spam box. It's better just to like ask them to join the email newsletter or to give them something in exchange for joining the email newsletter.
Got it. So, like, which tool do you use for these email newsletters right now?
Beehive is pretty good. Go High Level, Beehive. We're switching between those two, and yeah, those are the best ones I've seen. Because the issue is that some of the others, they don't like a lot of financial products. So Beehive and Go High Level are okay.
Got it. So the next big question is like, what do you send in these emails?
Okay. Well, you just send over three things. One is I'll send quote unquote case studies of how people that have worked with you have gotten the results. So either you talk to people or you coach people or you have interviews with people that are like the investors that you talk to and say how these people have gotten the results that the people on the email newsletter are looking for. So that's how you build, how many people have you worked with? That's how you answer that question. The second thing could be a piece of information in the industry that's very timely in the sense of a webinar, a YouTube video, or a lead magnet. So because a lot of news items happen, like for example, if somebody's acquiring car washes, say, the 100% depreciation rule that Trump is bringing that back. So the way that this is going to affect car washes is you're going to be able to defer tax more. So a lot of our investors are going to be able to benefit from, lower tax on their investments into car washes in this area. This is my analysis. And so pretty much you have to just have like some sort of analysis or some sort of piece of information that positions you as somebody who knows what they're talking about. And make sure that this is correct, because if it's not, then you're going to embarrass yourself. So make sure you do some research and talk about what you actually know. And one of the best ways to know about what to talk about is to see your past emails of people that you're already working with and see the questions that they've asked you and how you've answered it. So instead of you coming up with something from scratch that nobody asked for, you can just go back to past correspondence with some of your past calls with investors of things that you've been asked or things that people have told you about. And then that's how you know that it's interesting to people before you go out and tell it to people that you don't know. You can also test this out with your social media posts, because if your social media post goes viral organically, you're pretty well equipped for it to be important in an email. And then the last thing I would say is, offer a free lead magnet in terms of like either a webinar or an event, in person or a webinar. Don't do these too frequently. Like you want to balance it out with the value post, because if you have a 50% ratio between the value post and a call to action post, that's the minimum. So if you do those three things, then, once in a while, like whenever you need it, you just say, hey, we have an investment opportunity that's closing within like a few days. Here's how you can get access to the opportunity. And then they would actually start investing and trusting you once they see you on the email newsletter. They see that you know what you're talking about, and they see that you help people that are similar to them get the desired results that they're looking for.
Like, how many newsletter do you normally send? Like, what does the frequency looks like?
Yeah, I'm a bit aggressive, so I'm a bit like I don't recommend doing it up to my level. Like we do it like 6 or more per week, but I mean you're good at just 3 per week. Yeah, like you don't have to go crazy like us, but you're good at like 3 per week.
That's a lot. You still even 3 a week. For a lot of people, it's like 3 a week. I was expecting like 3 a month.
Oh no, 3 months is terrible.
Can you give us like a structure of what the structure of the email looks like? I mean, the newsletter email looks like.
The email newsletters, I really don't recommend. Like, you know how people make it all boxy as if it's like really corporate. I think those are terrible because the click-through rates on those are terrible because people want to talk to people. They don't want to talk to like a big company because they just want to talk to our people. So I think plain text, very few images, very minimalistic, straightforward text, and really personalized usually works better and has better results than something that is really corporate and templatey, like, you know, those MailChimp templates that are like nobody reads those and the read rates are really low and the click-through rates are really low. Having just 1 to 2 call to actions on a simple piece of text that's really plain text and few images and really personal, like almost like a personal brand, seems to convert higher than just having like a bunch of corporate jargon. I always use mail merge tags. So I would say, so there are 3 types of emails I mentioned. One is talking about kind of like a case study. It's like a mini case study. The second one is a piece of value. And then the third one would be a call to action to invest. Those ones are really rare, depending on your situation, or else you burn out the audience. So one would be, okay, let's see a value letter. Let's say you're teaching people how to acquire car washes because we have the client acquired 2 car washes. We just say, hey, like 2 million, how we acquired a $2 million car wash, or our name. Here's how we acquired a $2 million car wash. So subjects. And then the body will be hi name. You know, so what we want to do, we want to be like, there's sort of like a mini hook. There's a story, there's an offer. So like the hook will be something in the first sentence that causes them to, you know, want to read the rest of it. So every line in the email has to cause them to read the rest of it. Make it like a story. It's like, okay, hey, I was listening to, you know, let's say a podcast on a Sunday morning, and a text just came in. It said, wow, this car wash acquisition that you recommended to us, the funder actually funded the deal. And, you know, you're telling the story of how you saw the text and of the client that you're working with fund the car wash. And he's like, okay, you know, then I proceeded to, you know, book my next airline. I booked the plane, you know, to fly to the sites of the car wash. And then I was greeted with, you know, a bunch of videographers, photographers, and people celebrating that, yeah, this car wash acquisition was so hard, but we actually did it, you know. And then, you know, so instead of me making this like a long story, I decided to just make this into a YouTube video. So click here to watch the video of how we closed this car wash and how we provided returns for this particular group of investors. You know, so that's an example of something that starts with a story because human beings like stories. And then you build a bit of suspense in saying, hey, you know, here's this car wash that is the end result of what you're looking for. And then it got a lot of returns for specific investors. And then without saying all the details, you tell them to watch a YouTube video for more. And then the thing is that there's always this rule, it's almost cliche, but, you know, I think Google had a study where people have to consume 7 hours of your content or click on 11 pieces of content from somebody to build trust with them online. So the YouTube video is a quicker way for them to build rapport with you at scale because they're seeing your face, they're hearing your voice, and it goes into their limbic system for them to like subconsciously have like some sort of relationship with you. It's twisted, but that's how it works because human beings aren't really meant to be on the internet. Like, so people usually hear voices and see faces, and that's how you build relationships with people. But the internet is like a way around that because it kind of hijacks our limbic system, the part of our brain that associates with emotions and subconscious feelings, for us to build like some sort of trust with people. So anyway, long story short, that's kind of how you send the lead magnet type of thing. It could also be like a PDF. It could also be an ebook explaining it. It could also be an article. I like YouTube videos because YouTube videos seem to be the best at the audio visual components of getting into somebody's brain. So those are the things that I would say, and those are how I structure those emails.
So let's say, the investors are like had a conversation with us on the call, and they're like, hey, we are interested, we are interested in this deal. We are like happy to invest. Like, what is the next step? Like, are you gonna sign some certain agreements or something like that?
Yeah, either to sign a subscription agreement, a custom agreement made by a lawyer. They do that, and then they wire the funds usually to an escrow. So they can wire the funds to the person directly, but it's a bit like most people would do an escrow. An escrow, to those who aren't familiar, is just some sort of middleman service that makes sure that all the funds are in a secure, neutral place before it gets sent out to the deal. It's like, so for example, when I bought raises.com, the domain, it's a very expensive domain, right? So, but the way that we had to do it is there was an escrow service. So the person that was selling the domain put the domain in like a safe middleman. There was a third party company that put it in the middleman position. And then the middleman was the guy that got the domain, and it was the guy that got the cash. And then when we were both able to access the things, then he allowed, like when the middleman was able to access both of the things, like the credentials for the domain and some of the cash, and he made sure that both of it was sent in a timely fashion, then we're able to get access to it. So same thing with money and the deal. It's like, instead of just sending the money out to a deal, if the paperwork's not done properly, and if the escrow is not done properly, then people don't feel secure. So either a lawyer's trust accounts or an escrow will take care of that. And but in a long story short, sign the documents and then wire the funds usually to an escrow, and then offer the quarterly or monthly distributions to that investor, or based on whatever terms you had agreed to that investor. You're just wiring the funds to the proper bank account of that investor.
So, like, what is the like common deal structures and terms looks like, for deals like this when you're raising capital from these investors?
Sure, maybe like if they want to be a limited partner, maybe something like, they get a 2x return on equity or almost 2x return on equity, for lack of better words. I guess the purists will probably cringe, but for simplicity's sake, I mean, they put $1 in to get $2 out within a 5-year period, 2x return on equity, and then, yeah, sure. Like, let's start there within 5 years. That's one way of doing it. For those who want to preserve their money, those could be decent terms. And then we can also say, like, if it's more of a real estate play, we can say, hey, there's a preferred return of, let's say, 8%. So worst case scenario, you make 8% annually, or you get 8% annualized, and then you get paid the lump sum at the end of the 5-year term. So that's pretty super standard, so something like that can take care of them. And yeah, that's pretty much it. That's what I recommend.
Let's say we signed the agreement, they love the terms, and we are like, we got the deal. So we are moving forward. So let's say a year down the road or a year and a half down the road, we don't like the investor, for like whatever reasons, right? So is there a way to kind of like get rid of them, maybe replace with a different investor, or like what does that process looks like?
Sure. I mean, those are the provisions put in the PPM and the subscription agreement that the lawyer has to draft, and that's all written there. But there's this whole business that nobody talks about that's driven around, they call them secondaries. So secondary market trends, that's the secondary market. So that's secondary, like, market transactions. So there's this firm in New York I spoke to once, and all they do, they just buy up secondary limited partner shares or limited partnership units in deals that people don't want anymore. They want to dispose of. So it's a whole business, and you can just sell your shares to somebody else. Some people can do a buyback where they're buying back LP shares as well. But it's really just a bunch of people that are buying back interest in companies that they sold. Just like the stock market. It's like, if I have a bit of NVIDIA, it's people just selling it on the open market. So that's pretty much it. And that's usually the best way that it's done. But you have to be really careful of those things because, you don't want to upset the wrong investor. But yeah, in general, just secondary market transactions.
With Natu system in your toolkit, you can raise capital on demand. But now imagine turning those funds into 40% cash on cash returns. Watch this interview with Bawar Ahmad, where he shares his exact 90 days micro e-commerce flipping strategy that he has used to flip over 40 plus e-commerce stores in the past 4 years.